Wealth creation is the process of accumulating assets and resources over time. It is a critical aspect of personal finance and can help individuals achieve their financial goals, such as retirement planning, purchasing a home, or funding their children's education. There are principles and strategies that can help anyone build wealth over time. The sooner you start, the better your chances of success. Let's delve into the 7 principles of wealth creation right away. 1. Make money. The first step to building wealth is to start making money. This may seem obvious, but it's important to consider how you're going to earn money and what kind of income you want to generate. There are 2 main types of income: earned income and passive income. Earned income is money you receive for working, while passive income is money you earn without having to actively work. If you're just starting out, you'll likely need to focus on earned income. This means finding a job that pays well and that you enjoy. Passive income can be a great way to supplement your earned income and grow your wealth over time. There are many different ways to generate passive income, such as investing in real estate, stocks, or bonds. You can also start a side hustle or freelance business. The key to generating passive income is to find something that you're passionate about and that you can do consistently. Once you have a passive income stream, you can start to focus on building your wealth and achieving your financial goals. Before I continue, if you're new here, please hit the subscribe button so you make sure to never miss my weekly videos on wealth creation tips. 2. Set goals and develop a plan. Before you can start building wealth, you need to know what you want to achieve with your money. What are your financial goals? Do you want to fund your retirement? Pay for your kids' college? Buy a second home? Once you know your goals, you can start to create a plan to achieve them. Your goals should be specific, measurable, achievable, relevant, and time-bound smart. For example, instead of saying I want to save money, you could say I want to save $20,000 for a down payment on a house within the next 5 years. After you have set your goals, you should develop a plan for achieving them. You can do this by creating a budget to help you save more money, increasing your income through education or career advancement, or investing in assets that will appreciate in value over time. Make your plan realistic, flexible, and focused on the long term. Review your progress regularly and make adjustments as needed to keep yourself on track. 3. Save money. Making money is not enough to build wealth. You also need to save money. If you don't have enough money saved up for your near-term obligations or for an emergency, it's important to prioritize saving above all else. Many experts recommend having 3 to 6 months' worth of income saved up for emergencies. This should be a top priority. Here are some tips on how to set money aside for building wealth. Create a budget. Track your spending for at least a month to see where your money is going. Once you know where your money is going, you can start to cut back on unnecessary expenses. Set a savings goal. Decide how much money you want to save each month. A good goal is to save 20% of your income. Automate your savings. Have a certain amount of money automatically transferred from your checking account to your savings account each month. This way, you won't even miss the money. Find high-yield savings. Shop around for high-interest savings accounts and certificates of deposit CDs. Savings accounts and CDs with high interest rates can help your money grow faster. CDs typically offer higher interest rates than savings accounts, but you may have to lock up your money for a certain period of time. If you can afford to do so, CDs can be a good way to maximize the payoff of your savings. 4. Invest. Once you have some money saved up, it's important to invest it so that it can grow over time. Money in a savings account is important, but the interest rates are typically low and your cash risks losing purchasing power over time to inflation. One of the most important investing concepts for beginners is diversification. This means spreading your money among different types of investments. This is because different investments perform differently at different times. Another important factor to consider when investing is your risk tolerance. This is how much risk you are comfortable taking with your money. Younger investors typically have a higher risk tolerance because they have more time to recover from any losses. As you get older, you may want to reduce your risk tolerance. Investments vary in terms of risk and potential return. Safer investments typically have lower potential returns, while riskier investments typically have higher potential returns. There are many different types of investments available, but some of the most common include stocks. Stocks represent ownership in a company. When you buy stocks, you are essentially buying a piece of the company. Stocks can be risky, but they also have the potential to generate high returns. The value of a stock can go up or down, depending on the performance of the company. There are many different factors that can affect the price of a stock, such as the company's earnings, the overall state of the economy, and investor sentiment. There are two main ways to make money from stocks. Capital gains. When the price of a stock increases, you can sell it for a profit. This is called a capital gain. Dividends. Some companies pay dividends to their shareholders. Dividends are typically paid out quarterly, and they represent a portion of the profits that the company has earned. Bonds. Bonds are loans that you make to a company or government. When you buy a bond, you are essentially lending money to the issuer of the bond. In return, the issuer agrees to pay you back the principal amount of the bond, plus interest, over a specified period of time. Bonds are generally considered to be safer investments than stocks, but they also have lower potential returns. There are two main ways to make money from bonds. Interest payments. When you buy a bond, you will receive interest payments from the issuer of the bond. The interest payments are typically paid out semi-annually. Capital gains. When you sell a bond for more than you paid for it, you will make a capital gain. For example, let's say you buy a bond for $1,000 that pays 5% interest semi-annually. After 1 year, you will have received $25 in interest payments. If you sell the bond for $1,050 at that time, you will have made a capital gain of $50, which is the difference between the sale price of $1,050 and the purchase price of $1,000, plus the interest payments of $25. Mutual funds and exchange-traded funds ETFs. Mutual funds are baskets of investments, such as stocks, bonds, or a combination of the two. Mutual funds are managed by professional investment managers who are responsible for choosing the investments that will make up the fund. Mutual fund returns can come from several sources. Appreciation in the fund's net asset value (NAV), which happens if the fund's investments increase in price while you own the fund. Income earned from dividends on stocks or interest on bonds. Capital gains or profits incurred when the fund sells investments that have increased in price. ETFs are similar to mutual funds, but they are traded on exchanges like stocks. This means that you can buy and sell ETFs throughout the day, just like you would stocks. ETFs can also be a good way to diversify your portfolio and reduce your risk. 5. Protect your assets. Insurance is a way to protect your hard-earned money and wealth from unforeseen events. A fire, car accident, or premature death can all cause financial hardship, but insurance can help to mitigate these risks. It is important to consider insurance needs at all stages of life, even if you are young and healthy. Insurance rates tend to increase as you get older, so it may be more cost-effective to buy insurance when you are young. 6. Minimize the impact of taxes. It is essential to understand your tax exposures and develop strategies to minimize their impact. One way to minimize your tax bill is to invest in tax-advantaged accounts such as 529 college savings plans, individual retirement accounts (IRAs), and 401k plans. These accounts offer tax benefits that can help you save more money and reduce your tax bill. Another method is by holding investments for more than a year. You can take advantage of the lower long-term capital gains tax rate, which is generally lower than the short-term capital gains tax and income tax rates. 7. Manage debt and build your credit. As you build wealth, you may need to take on debt to finance purchases or investments. However, it is important to manage your debt carefully to avoid jeopardizing your financial goals. Here are some tips for managing debt and building credit. Be mindful of your debt-to-income ratio (DTI). Your DTI is the percentage of your monthly income that goes towards debt payments. A high DTI can make it difficult to qualify for loans and can also lead to financial problems if you lose your job or experience other unexpected expenses. Pay off high-interest debt first. Credit card debt typically has the highest interest rates, so it is important to pay this off as quickly as possible. Once you have paid off your credit card debt, you can then focus on paying off other debts with higher interest rates. Be wary of variable rate loans. Variable rate loans have interest rates that can fluctuate over time. This can make it difficult to budget for your monthly payments, and it can also lead to higher interest payments if the interest rate increases. Maintain a good credit score. A good credit score will make it easier to qualify for loans and will also get you better interest rates on loans. You can improve your credit score by paying your bills on time, keeping your credit utilization low, and disputing any errors on your credit report. Wealth creation is a long-term process that requires discipline, patience, and a clear plan. By following the 7 principles outlined in this video, you can increase your chances of achieving financial success. It is important to do your research before you make any investment and to understand the risks involved. I hope this video helps you in being one step closer to your financial goals. Please give a thumbs up on the video if you have enjoyed watching. If you have any questions, please leave them in the comments below. And be sure to subscribe to my channel for more wealth creation tips. I'd see you in the next video. Bye.